So for what I'm doing currently in the CRE space, so my company's Tauro Capital Advisors, as you mentioned, and what we do is we source debt and equity for all asset classes of commercial real estate across the country. But I guess the real answer is we help people solve a problem through sourcing that capital. Now, a problem isn't necessarily a foreclosure or something that's devastating. The problem could be that they have a loan coming due, or there's a partnership breakup and they may need to finance that split. So there are solutions. So we're basically solutions for situations, and we do that through capital. Now, with that said, because of the number of years that I've been in the commercial real estate business, as well as my partner, Scott Lee, we have advice that we can give them, maybe different ways to look at it. Maybe the solution is not necessarily a substitution of capital, but it might be a conversation with the current capital.
Quick favor before we jump in. It always surprised me that a large percentage of people who listen to the show regularly haven't yet subscribed. If you're a commercial real estate operator, investor, or builder who values conversations like this around deals, capital, and technology, please take 2 seconds and hit subscribe. It's a simple, free way to support the show. My commitment to you is that my team and I will continue bringing you higher level operators, stronger conversations, and real execution level insights every single week. Thank you. I truly appreciate it. Welcome back to the AI Edge podcast, a show where we sit down with operators, founders, and investors who use systems, data, and smart technology to drive real results in the real world. Today's guest is Steven Stein, president of capital markets at Tauro Capital Advisors, a fully integrated commercial real estate advisory firm sourcing structured debt and equity across asset classes nationwide. Steven started in investment real estate sales and later moved into leadership at capital markets with a career spanning multiple cycles and thousands of transactions. Tauro is known for being deeply execution-driven, relationship-led, and structured in thrive all market conditions. Steven described his career journey in one word: amazing. And I want to unpack that, what makes a long career in CRE capital markets not just successful, but meaningful. Steven, welcome to the show.
Thank you. It's my pleasure.
Thank you for being here. So let's
Of
start
course.
off with, when someone asks you, what do you do? How do you answer that in plain English, Steven?
So for what I'm doing currently in the CRE space, so my company's Tauro Capital Advisors, as you mentioned, and what we do is we source debt and equity for all asset classes of commercial real estate across the country. But I guess the real answer is we help people solve a problem through sourcing that capital. Now, a problem isn't necessarily a foreclosure or something that's devastating. The problem could be that they have a loan coming due, or there's a partnership breakup and they may need to finance that split. So there are solutions. So we're basically solutions for situations, and we do that through capital. Now, with that said, because of the number of years that I've been in the commercial real estate business, as well as my partner, Scott Lee, we have advice that we can give them, maybe different ways to look at it. Maybe the solution is not necessarily a substitution of capital, but it might be a conversation with the current capital.
Amazing. You summarized your career in one word: amazing. What makes it amazing, and what have been the biggest lessons that only show up after multiple cycles?
Sure. So for me, because of my career, the amazing would be the people. And in my career, because I started my commercial real estate career with Marcus Millichap as a salesperson, and then I went into management and then worked for another company and then started this company. So let's just start with as my part in sales, if you will. So I remember doing a sale for a woman. She bought an apartment building in Phoenix, and then I left, and I happened to be back in town, and she was there. And the broker that I was working on was now representing her in the sale. And at the time when she purchased the property, she had to cash in an insurance policy, and she did that. And I think she bought the property. I'll just, for example, say $1,000,001, and here 3 years later she sold it for 2.1 million. And she was ecstatic at the fact that now she was able to provide a lifestyle for herself. And so helping people create amazing situations, and it becomes more of just a transaction, but an experience and helping people. And then let's transition then into when I was in management. So the amazing part are seeing people that you hire, mentor, and see them grow and obtain results that they never thought was possible. So helping bring that out of people is really something that I call amazing too. And it comes back. People will call me and stay in touch and let me know where they're going, what they're doing. And, sometimes it's, they started as a salesperson and maybe their path was simply a salesperson, but then they started investing and they transitioned from being in sales to a principal, and then watching them grow and build wealth. So those are some of the things that become amazing. Obviously, the experiences that I've had, places that I've gone with the company, the different transactions that we've been part of, whether it be in sales or capitalization, it's really, to me, it's an amazing experience. And it's different every day.
That's beautiful. You've seen the industry from the ground level, investment sales, leadership, and capital market advisory. What's the through line that connects those chapters?
I mean, it's really commercial real estate. That's really the connection in all of it. And whether it is investment sales, whether it's management and mentoring, or whether it is capital markets, that's really the link of that. And again, also, and even in investment sales, it's creating solutions. It's not just sales, right? Because as you know, because you're an investor in commercial real estate, when you sell a property, then you either pay your recapture and appreciation, or you trade. And so you're creating solutions for people. And sometimes it's moving them from asset classes and helping them understand the advantages of that. For example, a lot of people will sell an apartment building and want to buy a single tenant triple net because sometimes it's called an armchair investment and there's no management, but there are some inherent risks that they may not know. And so that's the ability to provide them some guidance.
Let's talk a little bit about Tauro's origin story. Tauro is positioned as a fully integrated advisory platform. What problem did you see in the market that made you build it in this way?
Primarily, I would say the opportunity was how most capital advisors approach the business. And so, as I mentioned, I came from Marcus and Millichap, which George Marcus used to say, bringing Wall Street to Main Street. We kind of approached it similar because my partner, Scott, was a banker for 19 years. Worked for some family offices, and then he ran GE Capital's joint venture group from 2001 to 2009. So very much Wall Street. And so we took the approach of like, what was the best that came from his experience, the best that came from my experience, and we melded and created this company. And so we're very focused on the client. We're focused on the process. We're not transactional, where a lot of capital markets people are. And that may be how they're trained. That may be what the leadership guides them to do. But we really take a deep dive and we get to the point very quickly. So, for example, I'm sure you've seen as an investor, Lewis, where you get an offering memorandum and maybe 80 pages, and on page 72 is where the meat of it is. Our, what we call pitch decks, which would be an offering memorandum if it was sales, are generally 6 pages, and everything capital needs to know is right on the front page, either on the left side or the right side. And so they know whether they want to, go further. So they don't have to dig for it. And because Scott had been on the capital side, we designed it for capital. I had one of my capital advisors a number of years ago say, "Hey, can I give you some feedback from a client?" I said, "Absolutely." And they said, "Well, our packages look really great, but it's kind of inconsistent in the marketplace. Would we be open to changing it?" We said, "Absolutely not," because we don't write our packages for the client. We write it for the end user, which is the capital. And a lot of times, even in investment sales, they're really trying to placate the seller, if you will. So they want it to look good. They want to put all this information in, when reality is, as a buyer, they just want to see the meat. They don't really need to see all the fluff. So
Amazing.
that was kind of, if you want to call it, the problem is we wanted to simplify it. We want to make it easy, and we wanted to be client-centric.
I love it. Let's talk a little bit about what's actually happening in CRE capital markets right now.
Sure.
So if you strip out the headlines, what's the real story in the market right now? From your seat, What's easier, what's harder, and what's misunderstood?
So one thing that's the misunderstood, that's a great question, is we will have brokers or investors say, well, I don't want to do anything right now because I want to see what the Fed does. Are they going to drop interest rates? And what the misunderstanding is, that doesn't have an effect on what we do. When the Fed drops the rate, primarily it affects credit cards. If you have a car loan, it's consumer financing. It's not commercial real estate financing. Commercial real estate is tied to treasuries. And so as world events affect treasuries, their value, that is what affects us. Now, when the Fed lowers the rate, will it have some effect down the road? Possibly, because it does affect world events or events that happen in the country. But that's really, or LIBOR, I didn't mention LIBOR, but that's really what affects interest rates. But the one thing that's really important for investors to be thinking about, while interest rate is important, there are covenants in a loan that can be detrimental. And we understand that because we've done so many transactions and we actually read the documents. I've explained to someone that, hey, this interest rate may be a little bit higher, but the covenants that you would want to get out are stripped out, or we've already done that. So for example, it's not unusual for there to be a covenant in a loan document that the lender has the right to do an appraisal every year at the borrower's cost, or an environmental. Or let's say you're in a multi-tenant office building or retail where you have large tenants. There could be a covenant in that loan document that says if that tenant or a certain percentage of the square footage vacates, you actually need the lender's permission to put anybody new in there. They need to see all the marketing materials, what you're going to ask for rental rates and things like that. So they're really your partner. Now, lender's always your partner. I don't care what the covenants are. They're really a partner. They just get a preferred return. But in this case, we can negotiate that. So there's other covenants. I can go on and on about that, of the things that people should be aware of. But that's what we do.
Easier or what's harder?
Well, the hardest thing is getting people to really appreciate kind of the value we bring. That's always tough, even on the investment sales side. And the tough part is, unfortunately, I always say there's a lot of bad actors in our theater. Now, that doesn't mean they're doing anything nefarious. It means they're doing things not to the extent that we do, not with the professionalism that we do. And I encourage the people that I work with or I've ever had the chance to mentor is to look at ourselves very much like a client should look at their attorney or their accountant. We're professional. And so there are things that we can show that professionalism. The hard part is there are a lot of people that don't do that. I've had lenders that really will compliment us. I mean, you can even look on our website. We have a lender that says, hey, if I were to do a loan personally, there'd be no other group than Tauro. Simply because, again, of the attention to detail that we do. We've had lenders say to us, or capital providers say to us, it's really a pleasure to work with your group because we have capital markets guys like you that send us the deal and they go, just tell us when we can pick up our check. We're not like that. And even today, I had a conversation with a lender where they were communicating directly with the client. And I said, we don't need, like, for example, if the client has to send in financials, their personal financials, we don't need to see that. That can go directly to the lender. But you need to keep us in the loop. And so I called the client and I said, hey, I just want to let you know I spoke to the lender and there was some confusion. So now I had to do a conference call with everyone. So keeping us in the loop is truly important, but that's one of the hardest things. There's many hard things in what we do, like I say, convincing clients of the value or explaining to them the way capital markets work. It's not a commodity. As I mentioned, negotiating covenants and things like that. And people will walk into a bank and bank will say, hey, here's the loan. And they just think that's the lending environment. About a year ago or so, maybe a year and a half ago, clients were saying, well, no one's lending. And that's because they walked into their local bank and the bank was lending. Well, that's not what the marketplace is. There are plenty of lenders. There have been always plenty of lenders in the marketplace. Not necessarily the most affordable or terms, but there are lending solutions. And then again, people are looking at, for example, 10-year fixed loan. Well, maybe it's better to use a 3-year fixed loan that has options to extend, and then you also have no prepayment penalty. And then there's also federally chartered credit unions. If they're federally chartered, there's no prepayment penalty. So there are many different solutions, but a lot of times people are so fixated on their experience and they're not knowledgeable about what's in the marketplace. I just came back Monday and Tuesday. I was in San Diego for the Commercial Real Estate Finance Conference, meeting with 30 plus lenders. And so there's a lot of variety out there. There's some similarities, but a lot of variety that they just don't have exposure to that we do.
Amazing. When sponsors come to you today, Stephen, what are the most
hmm
common challenges and what are the most common solutions that you're structuring?
Sure. Most common challenge is the cap rates, and hopefully your audience knows what a cap rate is. So they could still be low, and so the interest rates are high. That's what's called negative leverage. So negative leverage would be the cap rate, which is how you value the income stream. Let's say it's a 5 cap, and interest rates might be at a 6.25, or even if it's 5.75. So that's negative leverage, just meaning the interest rate is higher than, let's say, the return would be if you bought it all cash. So getting clients to understand that, and then recourse versus non-recourse, what does that mean? What are the implications? How to navigate that? How to negotiate it? Because even on a recourse loan, we can negotiate maybe the top end of the recourse or burn off, or there's like triggering recourse, so different things that we can do. But again, the hard part is getting clients to really understand that process and how to better negotiate that.
And what are the common solutions that you're structuring?
Well, the common solutions really are competition, getting the capital to compete for the business. So when we get hired, we only work on an exclusive basis, which makes us a fiduciary. We have no correspondent relationships with any capital source. So our allegiance is solely to the client. So that's really the solution, is to create competition, not unlike investment sales. So investment sales, their job is to make buyers compete. You'll hear, if someone's an investment salesperson in their career, they'll try to get a client to list the building with them, and the client will say, well, my neighbor offered me a really good deal. And that may be true, but when you go to market, that deal probably isn't the best deal. And it's the same with the capital. One thing that sponsors not always appreciate is capital a lot of times just looks at them as a sponsor. They'll look at groups like us as the client. In the heyday, before the downturn the last couple of years, we were in the market on 70 deals. So lenders wanted to see deals from us, and we had lenders that will come to us and they go, we'll give you better pricing, just show us more deals. Whereas a sponsor, and I really don't care how big you are, BlackRock or you name it, they're not out in the market on 70 deals in a year. Okay. And let's face it, they're very prominent and lenders want to work with them, but they look at us, like I say, as the client, because we're showing them so many opportunities.
What does a financeable deal look like today?
Well, I mean, a financial deal, it really depends because the leverage point. And that's another thing that we have to help sponsors understand. So they'll go in, or they'll hear from other brokers that maybe aren't approaching it the same way, that say, hey, the lender's going to offer 75% loan to value or loan to cost. Well, they may be able to do that, but there are going to be other constraints that it may end up being 60%, 65%, loan to value or loan to cost. So that's something that we have to educate, sponsors on, that there are constraints. So typically it's going to be loan to value, loan to cost. It will be debt coverage ratio constrained. And there's also what's called debt yield. And for the audience that may have not be familiar with debt yield, basically what that means is what's the yield the lender's going to have if they take the property back. So for example, if they give you $1 million loan and there's $80,000 in net income, that's an 8 debt yield. It's very simple. So, but it is constraining. Typically in today's market, loans are constrained by debt coverage ratio.
What's different than it was 2 years ago?
It's probably a little bit better than it was 2 years ago, because I think people now understand that, interest rates are probably leveling off. And I would say it could go a little bit lower, but let's call it between 5.5 and 6.5. And that depends on a lot of factors. I don't want the audience to think that, why is it there's a spread? The spread is dependent upon term. Could be a 3, 5, 7, or 10 year. Could be recourse versus non-recourse. There's prepayment penalties. So there are things that affect the interest rate, along with the sponsorship credibility, liquidity, and net worth.
What separates sponsors who get capital from the sponsors who get stuck?
So there are a couple of things. That's a great question. One is the liquidity and net worth. Typically, liquidity should be equal to typically 1 year's payments. Now, on construction, it could be a little bit different. It could be by a percentage of that loan. The net worth typically is equal to or greater than the loan amount. And so the other thing where sometimes sponsors get stuck. We've had sponsors or clients come to us and they left very big companies and they controlled development and they were integral in all of that. Now they're going out on their own. Well, capital looks at it. It's their first time where it's their money. And so a lot of times what sponsors need to appreciate is they may have to do that with family and friends or their own capital, do one or two full turns, meaning they purchased a property, completed their business plan, and then sold it, or could be refinanced it. So sometimes those are the things that get in the way for sponsors. Again, liquidity and net worth or experience. I'll give you an example too. We're working on a project right now in Phoenix with a very seasoned sponsor. They are probably the most active sponsor in this part of Phoenix. And we're out in the market on a larger project. And while they've done 14 projects in this area, their liquidity and net worth is well above where it needs to be. We're getting some pushback, at least from one lender, saying, well, this is your largest project. You may need to bring in a co-developer.
Why is that?
Simply because it's a larger project. So this is 125 units. Their largest, multifamily, obviously, their largest project to date was about 40 units. But they've completed many projects down there. So lenders, it's all risk adjusted. And not every lender has that issue. One does. And their pricing is good.
Excellent. At your level, this is not just relationships, it's a process. What does your internal operating system look like to move deals from lead to close consistently?
It's really hands-on. I mean, I know the podcast is the AI advantage. Your edge, rather. We use AI to some extent, but this is truly a hands-on process because there are issues that come up. There's no easy loan. There are issues that come up, and there's a lot of hand-holding both for the sponsor and the lender. We need to review documents that AI can do, and we've used it. Like, for example, we'll put 200-page phase one into ChatGPT or whatever they're using, and very quickly it summarizes what it is. But there are components in a lease that, at least in today's world, AI won't understand necessarily. So there could be co-tenancy clauses. In California, there's Prop 13 protection. And there, again, things that we need to look at. Title report. A lot of capital advisors don't look at the title report. Well, that could be a killer if someone's not paying attention to it. And usually the title officer is and the bank is, but we want to get ahead of that game so that it's not rushing at the last minute and then closing gets delayed. So the process really is, intake of the materials. And again, we may throw it into an AI bot or whatever to help us. But generally the process is we have a closer, they're working on it daily and having conversations both with capital and sponsorship and the capital advisors.
Let's talk a little bit about how great capital advisors actually win. I'm talking about your operating system. Where do deals usually break and what are the best teams doing to prevent that?
Sure. They usually break when new information comes to light. And it could be, for example, in the title report. There could be, for example, when you pay off a loan, there's what's called a deed of reconveyance, meaning that the lender, when they get paid off, are reconveying their rights to potentially foreclose. Sometimes those don't get removed. And we've had occasions where they're still on title, but the lender's no longer in business. And so how do you get that removed? And again, this is really important if people are in a 1031 exchange. And again, I'm assuming the audience may know you've got 45 days from close and then another 135 or 180 days to complete the transaction. Well, if those types of things aren't attended to right away, if you miss that deadline, the IRS doesn't care. So there could be break there. Years ago, we had a transaction. It was a construction in Northern California. And we always ask the question up front, is there anything on your record that may give a lender pause? And they did say, hey, we had a bankruptcy about 13 years ago. And so that was disclosed. What they failed to tell us was 25 years ago, he was convicted of mail fraud and spent 6 months in prison. And even though he had, cleared all that out and became, successful entrepreneur in real estate, the lender felt like, he was hiding that. And so that fell apart. Again, when I say new information, it doesn't mean anything always criminal or things like that. It could be the fact that a tenant has moved or given notice during a transaction. So that changes, the lender's risk profile. There could have been a fire. There could be criminal activity on the property. A lot of times in certain areas where apartments are, or even, commercial, there could be criminal activity. Oddly enough, let's say it's a construction project and they put a porta potty on there, and the lender comes out and our title does, and usually title does that inspection like the day before the close. And people are going, well, what does that? Why does a porta potty have anything to do with breaking a deal? Well, because that vendor could have a potential lien on the property that could be in front of the lender. And so you can get that off pretty quick, but let's say it's a fence. Maybe you fenced it off because you want to have protection. Well, there could be a mechanics lien ahead of the lender. So there are certain things that happen and you just have to be on top of it.
Let's talk about the Tauro difference. You talk about culture, senior management support, and non-competing ownership. How does that translate into better outcomes for clients?
So I think it's just the overall product that we deliver, the fact that, as you mentioned, non-competing management, meaning that if a capital advisor asks me to go to a meeting with them, in a company that I previously worked for, the senior owners were happy to go on a meeting, but they're also producing. So if they're coming on a meeting with me, I'm taking them away from their production. So the first conversation is, how are we splitting the fee? If somebody brings me or my partner Scott on a meeting with them, we're there as ambassadors for the company and help support that advisor win the business. So I think one of the things it does, it helps for longevity with people staying, so they're not moving around a lot. It does happen. We've had it happen as well. I mean, we're not immune from that, but it's a culture also of collaboration. So, for example, there's going to be two components to this. We have a pipeline meeting every Tuesday, and we actually invite clients to listen in, even competition, because we work on an exclusive basis. And the reason we're even letting competition in, I mean, in my previous life, when I was in the special events business, people that did similar things that we did, like we produced haunted houses many, many years ago, and the people had done it very poorly. So now all of a sudden we were tasked with doing things differently. Same thing in what we do today. So we're happy to share with our competition our process. But we start out every Tuesday. We go from 9 to 10:30 our time. The first 45 minutes we reserve for capital, both debt and equity, to present to us. And in the last 3.5, 4 years, we've had over 400 groups present to us. And I don't know any other capital markets group that does that. I mean, when we started and it was only three of us around a small table, we still did that because we knew that that was important. And so we're hearing from capital, are they in the market? Are they not in the market? How are they underwriting? What they want to see, what they don't want to see, because their appetite changes as well. But to get to the second step, we go through every deal after that in our system. And it's not just when are we closing? How's capital treating you? Are you getting renegotiated? All the nuances to the capital markets assignment that we're in. And so we share information which help us provide a better product to the client.
That's beautiful. You referenced the idea that tough conditions can be the best time to hire productive people. Why is that, Steven? And what traits do you look for?
Well, the reason why in tough times it's the best time is because that's really where clients will see more value. And when they see more value, that capital advisor has to be dedicated to providing that value. So it's digging in deeper. A lot of times it might be that we're providing services that are not necessarily tied to the capital assignment right away, but it's maybe helping them position their property, things that they can look at doing differently based on our experience with other properties or sponsors, and helping them position themselves to be better once the need is or the opportunity is to refinance or sell or whatever. Now, we're not going to help them sell, but we can help them on the capital for the next project, and we can be there for a buyer of their property. So it's providing that in that tough time in value. So it's also staying on top of the information. Encourage all of our capital advisors to spend a good portion of their day, typically in the beginning of the day, to make sure they're reading or through the internet, whatever, the different opportunities there are to get information that they can then share with a client. And that's really what separates, probably, that's one of the best traits that, and I've worked with a lot of successful people, both in investment sales and in capital markets, not calling every time and say, hey, do you want to list the property? Or, hey, do you need a loan? Hey, this just happened. Or did you realize that they're going to create this new battery, industrial property. It's going to drive employment. And by the way, here's the figures and facts and things like that. Providing good information to help them make decisions is what people who make a lot of money in the commercial real estate business, either side, capital markets or investment sales, is providing good grounded information and staying in touch and caring, right? So, when I was in investment sales, and I was selling apartments at the time in Phoenix, I might drive by a property and there'd be graffiti on it or trash left out front. I'm just going to call and say, hey, Lewis, just want to let you know I was by your property. Here's, what I'm seeing. And because a lot of the owners don't necessarily live where their property is, so they don't go by it. So again, it's providing good information that they can help make decisions.
That's beautiful. Let's talk about systems, technology, and AI and capital markets. All right.
Mm-hmm.
So this is the AI Edge podcast. Where does technology actually help a capital market shop today? And where is it still overhyped?
So I think that it's overhyped, and I'll get back to the advantages. I think it's overhyped and people get a little bit nervous that it may replace salespeople or advisors. When LoopNet came out many, many years ago, that was the fear because LoopNet is a way to promote properties for sale, or lease. But again, there's that human element that technology, and it may catch up, like I had mentioned before about co-tenancy clauses or Prop 13 protection or all that kind of thing. AI is good with information. It's not good for problem solving. It can provide information to help solve the problem, but there's that human interaction. So I do think there's a lot of advantage to, like I say, put a environmental report in and it say, here's the issue. So it can help very quickly. It can read a lease and it can give you some good information as well. I think where we have to be realistic is we just can't rely on that totally. And also, you could put a lease into it and give you some information. But also, if you've got 100 leases, it can be very cumbersome. And there's a lot of questions that need to be asked that AI, at least at this point, won't be able to decide. And so, again, it's a tool. And I think it won't replace us, but I think we have to embrace it as a way to speed what we do. Because, it's funny, I was at a ULI meeting the other day, and I happened to say there's a saying in real estate, and before I could get out of my lips, a couple other people said, time kills deals, and it does. And so the more that we can embrace AI to help speed up that process, but it's no different than if you're on a team. And Harvey Green, who used to be the president of Marcus Millichap, always said, you have to inspect what you expect. That's still the same with AI.
And where does it actually help?
It really helps, like I say, in speed. But again, you just have to make sure that you just have to inspect it. Now, with that said, where I help, I'll use it to double check an email or a letter I might want to send. Because there are emotions that happen in any business. The beauty about AI, it takes that emotion out and it can maybe craft a better correspondence. So I use that a lot as well in different articles. It's good, because it will correct things and put things in its place. So I think there's some good value there.
Steven, if we keep it practical, where do you see AI creating real leverage in the world over the next 12 to 24 months?
It's a good question. I mean, in our business, well, I think, as you say, leverage in the world, I think it's really just speed mostly. And also, as I mentioned earlier, it will help tighten up correspondence, things of that nature. And I think there's some things obviously that I'm not aware of that that probably are tools that we should be looking at. One of I think the challenges with AI, it's very similar to somebody said, hey, did you see on Netflix this show? There's so much content that's come out, you can't keep up on every show. I think that's the same with AI. Every day there's some new AI tool and it just takes time to test it, to understand it. And so if that could get simplified, that would be great. But there's just so much coming at us with AI that we just don't know sometimes where to start. And I think that's in every business.
Amazing. How about as far as intake or underwriting?
Well, absolutely. I think in underwriting, it can. Again, though, only to a point. As it improves, I mean, there's some sophisticated underwriting and structuring, and that happens through conversations. It's not just something you put in a ChatGPT and it comes back. When we approach everything, we always approach it from the exit strategy. And the exit strategy could be a sale, it could be something that you're going to leave to children or whatever, so estate planning. It could be refinance. So there are a lot of questions that have to be asked along the way. It's just not, hey, what do you want to have happen? And as they start telling us, then we can structure. I always look at it as like an inverted pyramid, right? So you're asking a lot of questions up here, and then as you ask more questions, you get to the solution. And so it can provide some good help, but again, there's that human element. There's questions, there's things you want to ask or think about, especially in estate planning. I mean, in lending, there is either recourse or non-recourse. Even if it's non-recourse, there needs to be a warm body for what they call the bad boy carve-outs. I mean, I've helped elderly people that have to think about that because if they unfortunately pass away, that loan could be called simply because the lender relied on the liquidity net worth of that particular sponsor, even if they're a trustee of a trust, right? So we have to think about that up front. I'm not sure AI will get there, but maybe they will at some point.
What about lender targeting and matching?
So really great question because we get approached by different groups that have the next best mousetrap for that. So what all of them are focused on is past lending reporting, right? And it is good information, although the lenders, whatever they did yesterday doesn't mean that's what they're going to do today. Lenders can't be on the phone with all of these purveyors of that tool because they'll never get any lending done. So even if they publish a rate sheet, that's why companies publish a rate sheet every week. And so it's good, useful information in a sense, but also there was one tool that came out and said, hey, we're going to give you a list of all the lenders there. And if they moved, let us know and we'll try to figure it out. Well, that's not saving us any time. So again, there's good information to a point, but it's not real time and lenders change.
What about pipeline forecasting?
That's tough. In a sales organization, that's extremely tough. Everyone does it, and it's a great way to inspire the salespeople to get out there and hit certain goals. But there's so much in sales that we don't control. And I mean, it's a myriad of things. So we'll all try to forecast, but I guarantee you no one's forecast in 2025 or hit what they forecast. I'm sure it was substantially below. And it's tough. And then again, in the sales, especially when you're commission, especially in the tough times, you'll lose a lot of people. And that's good sometimes, for that to happen, both for the person that leaves, it's not the right job for them. And then it's good for the company because the company there's a lot of hard costs that a company has to incur regardless of the market, whether it's rent or whether you're paying for CoStar or you're paying for Construct Connect, or you're paying for all of these technological tools. The cost doesn't necessarily go down simply because the market changed. Now, some of them have reduced what the cost of those systems are. But so again, to forecast, it's really tough.
Let's talk a little bit about speed and credibility. In capital markets, speed equals credibility. What is one workflow you wish every sponsor had systematized before they ever ask for capital?
Their information organized. I mean, we've had people that just give you a shoebox or, they just don't have it. They didn't think about it. Like in handwritten notes and things like that. So organization of information is critical.
What should people be careful about with AI and underwriting? Structuring and borrowing messaging, where can it create false confidence?
Well, I think that people, if they think that that's the end all to it, it still has to be checked. And there are going to be, mistakes that happen. And some of that can be, as they used to say, garbage in, garbage out. So for example, if someone puts an Excel model into, AI, we find this all the time where certain cells are hard coded or certain links to other worksheets that just aren't there. So AI may just interpret that one way, but it's not the correct way. It's not the fault of AI because that's just how it's programmed, but it may not be the correct. So that is the kind of the challenge and the thing you just have to look out for.
Absolutely. Let's talk about practical takeaways for sponsors. So give us the sponsor playbook. If I'm a sponsor trying to refinance, acquire, or recapitalize this year, what are the top 5 things I should do to increase my profitability over a clean execution?
So one of the things, and it may sound self-serving, but hire somebody like us.
Yeah.
That I think is the critical mistake a lot of people don't do, even if they've been in the business for a long time. The fact remains that we're talking, I think in our database, we have over 4,000 capital sources. We're not talking to them every day, but we can use that database. It's Salesforce. We call it Brahma because of Tauro, that we can go in and put certain qualifications in there, and that will get us, the capital to talk to. The other thing that I think sponsors need to also appreciate is they don't have that information of, like, again, they weren't at CREF like we were just at, or IMN, which is for equity, or the National Multi-Housing Council. I mean, they're not going to all of these, or for retail ICSCs. So they don't have the advantage of that information that we do, because that's all we do. So that's why, again, it's important. And then the other thing I think sponsors, and I understand, and part of it is what I said earlier, there are a lot of bad actors in our theater, meaning we only work on an exclusive. And a lot of sponsors don't want to sign up. And that was the same thing in investment sales. A lot of it is, in the past, they said, well, I didn't need to hire anybody. I got a great deal with my neighbor. So they're not fully appreciating what competition is doing. And then they have people, or they're interacting with people like us, but that don't care about the exclusive, because I shouldn't say most, a lot of capital advisors or people in sales don't have an appreciation for their own time because it's limited. Can't create any more of it, right? And so there are a lot of people that will do that. And then they also approach the process differently, sloppily. And so, the sponsor will say, I can't sign up with you exclusively because I had a really bad experience. Well, that's understandable, because that's the way it was set up, where we don't approach it that way. So again, I'm not sure I'm hitting all of it, but hire somebody like us, get access to great information. The other thing is, a sponsor will say, hey, when should I bring you in, especially on the acquisition side? We always say as soon as possible, because we can actually help them craft their offer, which makes it more credible for the seller. Or in the event that it's listed with a broker, one of the things, especially because I was in that brokerage world, but there are a lot of people do what I do that did. You may know the investment sales agent. And if they know that there's a credible capital markets person that's helping that buyer, that will help them promote probability to the seller. Because in the investment sales side, and the same on our side, probability is paramount. So you have to create processes in the scenario to impress that the probability is greater working with a buyer necessarily, or a certain capital advisor. And that's the whole goal, right? Is to get it over the finish line in a timely fashion.
Beautiful, Steven. I think that was 3. Do you have 2 more for us?
Let me give that some thought. For sponsorship and preparation to increase speed and probability, be open to the information. Don't be set in your ways of how to do it. Like, for example, somebody might say, I'm not going to do recourse. And I understand that. And it's a scary word, but being open for us to help explain why that may not be as scary, how we can negotiate that, and then be realistic. I guess that's really just be realistic, and maybe, I'm not sure that's exactly 5, but best I can do right now.
Love it, Steven. People confuse debt and equity consistently. What's the simplest way to explain the difference and when each makes sense?
Sure. So for debt, that's a lender, and they can foreclose. That may be the easiest thing. Equity cannot foreclose. They can maybe do certain things differently. And that's, actually, as I say, it's not true. Equity can foreclose depending on how that's set up. So there is what's called a UCC1, and that is a way for potentially equity. And there's different types of equity, right? There's preferred participating, and there's common. There are ways, like the building that I'm in was foreclosed not by a lender. It was foreclosed by an equity source that had a UCC1, not on the real estate, but on the entity that owned the real estate. So they actually didn't foreclose on the entity, the property. They foreclosed on the entity, and the property was part of that entity. But primarily, the lender capital, the loan, is typically going to you can have a 10-year term. Typically with equity, it's usually 3 to 5 years. So there are some different nuances to them. The equity is definitely a partner. There is a partnership agreement where there is a loan agreement with different covenants. You're not going to have covenants in an equity agreement that you're going to have in a loan agreement. So there are definite differences between the two.
Steven, how should sponsors communicate with capital advisors to keep velocity high? What helps and what hurts?
For sponsors to communicate with, I think on a regular basis, it makes sense to have a relationship with a capital advisor or shop that you're constantly talking to. So you'll have great information on how capital markets, both debt and equity, are looking at the markets. It will just help plan better. And even if you're thinking as a sponsor to hold something long term, like for example, we like to give people options, not obligations. So that's why we use a lot of federally chartered credit unions, because you can prepay at any point in time with no penalty. But they're also with regulated lenders. We can find lenders that maybe allow a 10 or 20% pay down every year. Because, so like, for example, years ago, we had somebody say, I really want a 20-year AM because I want to lower my loan balance right away. I said, well, how about if we get you a 30-year AM, but you have the ability to pay down, because life happens. And so you never want to get caught, well, I'm on this 20-year AM, so my cash flow's gone down that I really need now. No, let's have a 30-year AM or a 25-year AM, whatever it might be, but you can pay as much down every year as you want. But that is based on what your situation is at the time. Because like I say, life happens. And so that's why we like to give people options, not obligations.
But Steven, let's land this plane. Let's do a little lightning round, some quick hitters.
Sure.
You ready?
Sure.
Most common mistakes sponsors make in today's market?
Really not using a capital advisor.
Definitely should be using Tauro.
That would be great.
One metric you look at first when sizing a deal?
Well, there's a couple metrics that we look at. First, net worth and liquidity, because the deal can make sense, from a standpoint of how that is, but the sponsor doesn't. And the sponsor could look great, but the deal doesn't for specific metrics.
One thing sponsors underestimate about lender psychology right now?
Well, I guess what they underestimate about the psychology is how they are forward looking. How is the lender anticipating the market? And some of it is that they don't understand what the past has looked like. So do they have bad loans currently right now? So for example, there may be a lender that did a lot of multifamily loans more than retail, but they've got a lot of multifamily loans or retail, whatever it might be, that's going bad on their books. And they just don't understand that because they're not having those conversations with them.
One boring habit that creates outsized results in capital markets?
Boring habit, outsized results. I'm guessing that's to the positive. I guess it would be operating conservatively.
Last one, your definition of a great execution?
One that's successful.
Fantastic. Steven, for people who want to connect with you and learn more about Tauro, what's the best place to find you online? I'm
on LinkedIn. And then we also have our website. And for the benefit of, your audience, Tauro is TAURO. So it's www.taurocapitaladvisors.com. But again, I'm on LinkedIn and look forward to speaking with anybody. And I would encourage the audience, even if they want to just pick up the phone and pick my brain, happy to do that. And by the way, also, if somebody that's listening is interested in getting into this market, whether it be investment sales or what we do, happy to talk to them as well and give them some guidance.
Do you want to leave your phone number?
Sure. It's 213-268-4006.
Fantastic. Definitely contact Steven. We'll drop those in the show notes. Steven, I appreciate you making the time. This has been the AI Edge podcast. If you got value from this episode, share it with a sponsor, an operator, or a capital partner who cares about structure, speed, and execution. And we'll see you on the next episode. Thank you, Steven.
My pleasure. Thank you.